Today, we're diving into the future potential of Broadcom, one of the giants in the semiconductor industry, and exploring why this company still has significant room to grow. We'll break down its AI strategy, custom chips, and long-term growth drivers. Plus, we'll take a close look at Lululemon's recent earnings, analyzing whether the latest stock drop was justified and if the company is truly profitable. Stick around, because we're unpacking both tech and retail to see where the opportunities and risks really lie. Broadcom has recently made headlines by securing a $10 billion order from a major hyperscaler, believed to be OpenAI, for its customized AI chips called XPUs. While exact numbers weren't disclosed, the deal likely covers 1 to 2 million chips that will be deployed across thousands of racks and nodes. This is one of the largest AI processor deals in semiconductor history, signaling a significant shift in how AI infrastructure is built and how investors view Broadcom's future. OpenAI, historically dependent on Microsoft's AI infrastructure for running ChatGPT, appears to be moving toward proprietary hardware optimization. The rationale is simple. Even a 20% efficiency improvement on $10 billion in infrastructure could translate into $2 billion in savings. Additionally, hyperscalers are increasingly motivated to reduce dependence on a single provider, accelerating the adoption of custom silicon across the industry. Broadcom's XPUs will focus on inference workloads, the doing phase of AI, where AI is actually deployed and used by millions of people. Shipments are expected to start in 2026, securing OpenAI's AI infrastructure for years ahead and giving Broadcom a prime position to capitalize on the next wave of AI buildouts. Moving to company performance, Broadcom's Q3 2025 AI revenue rose 63% to $5.2 billion, surpassing management expectations and marking the 10th consecutive quarter of strong AI-driven growth. For Q4 2025, management expects AI revenue to reach $6.2 billion, and growth in 2026 is projected to accelerate beyond the 50 to 60% range. By fiscal 2026, AI revenue could hit $45 billion, representing nearly half of Broadcom's total revenue and solidifying its transformation into an AI-first semiconductor company. Broadcom already has multi-year partnerships with Alphabet, Meta, and ByteDance, and adding a fourth hyperscaler reinforces the company's strategic position. While some skeptics question whether custom silicon can replace general-purpose GPUs, AI workloads are fundamentally different. They require specialized accelerators for massive parallel processing. Broadcom's IP, custom silicon, and network infrastructure create strong pricing power and long-term revenue stability. Another underappreciated aspect of Broadcom's AI strategy is the Jericho4 Ethernet fabric router, which is specifically designed for distributed AI infrastructure. Jericho4 can interconnect over 1 million XPUs across multiple data centers, with 36,000 hyperports operating at 3.2 Tbps each, featuring deep buffering, line rate encryption, and long-distance transport. Essentially, while GPUs or XPUs act as the neurons of AI, Jericho4 serves as the nervous system, connecting these neurons across locations. This capability solves critical challenges for large-scale AI models, such as power constraints and the need to distribute workloads across multiple sites. Compared to NVIDIA's NVLink, which enables GPU to GPU communication, Jericho4 focuses on network switching infrastructure, a space where competitors like Cisco and Arista have products, but none integrate as seamlessly with custom AI silicon as Broadcom does. As AI workloads grow beyond single data centers, Jericho4 positions Broadcom as a key enabler of scalable AI deployments. Leadership is also a key factor. CEO Hock Tan, 73 years old, has committed to staying in charge through 2030, ensuring continuity during this critical AI expansion phase. His compensation is directly linked to AI revenue targets, with potential earnings of $616 million if Broadcom achieves $120 billion in AI-driven revenue by 2030. This alignment shows the board's confidence in both his leadership and the company's AI opportunities. However, Broadcom faces regulatory headwinds, particularly in Europe. Following its $61 billion VMware acquisition, concerns arose about licensing changes that affected European customers. CSP filed a legal complaint with the EU General Court, citing the European Commission's stance toward Broadcom. While this poses some risk, it is likely manageable, as the European Commission had already approved the acquisition with some concessions, and resolutions typically follow predictable patterns. Looking at stock performance, Broadcom trades at $359.63 per share with a forward PE of 84.5x, significantly above the semiconductor sector median of 31.73x. Despite this premium, the stock has delivered 127% returns over the past year and roughly 900% over 5 years. Broadcom's custom silicon model, multi-year hyperscaler contracts, and first-mover advantage justify the valuation, with significant upside potential as AI revenue continues to grow. Many investors and analysts are still anchored to traditional semiconductor metrics, but Broadcom's transformation into an AI-centric company could re-rate the stock higher as the market fully recognizes its role in next-generation AI infrastructure. Tab 10, Trading 212 Broadcom is not just building chips, it's building the entire AI ecosystem, from custom XPUs to large-scale networking infrastructure, backed by visionary leadership, strong customer relationships, and multi-billion-dollar contracts. For investors and the AI industry alike, Broadcom's strategic positioning makes it one of the most critical players in the AI revolution. Now let's take a look at Lululemon and its recent earnings. Lululemon Athletica recently reported quarterly results that, despite missing revenue estimates slightly, show the company remains highly profitable and fundamentally strong. The company posted revenues of $2.5 billion, up nearly 7% year over year. Breaking it down regionally, the US saw only a 1% increase, while international revenues surged 22%, with mainland China driving 25% growth. Overall, international markets now account for around 30% of total sales, and digital sales make up roughly 39% of total revenue, growing 9% in the quarter. Lululemon also expanded its global footprint, adding 14 stores to reach over 780 locations, with growth focused on China and Mexico. On the profitability side, gross margins came in at 58.5%, down 110 basis points, while operating margins fell over 210 basis points to 20.7%. The company reported a GAAP EPS of $3.10, beating analysts' expectations by 25 cents. Lululemon ended the quarter with around $1.115 billion in cash and no long-term debt beyond lease obligations, providing strong financial flexibility to navigate operational challenges. The company did lower its full-year guidance, expecting sales between $10.85 and $11 billion, and EPS between $12.77 and $12.97, slightly below analyst expectations. Despite this, the market reaction has been very negative, driving the stock down over 20% in recent quarters. The main challenges come from the U.S. market, where softness persists, as well as tariffs and the removal of the de minimis exemption affecting e-commerce shipments. Inventory levels also increased nearly 20%, which may require markdowns or write-offs. However, there are significant opportunities for growth internationally. China stands out as a major driver, with strong e-commerce platforms like Tmall, Douyin, and WeChat fueling online sales, while social commerce and live stream shopping continue to expand rapidly. Expansion in Mexico and other markets adds to the growth potential. Lululemon remains strong with solid margins, profitability, and free cash flow. Historically, the company has grown around 20% CAGR in sales, and international momentum should help maintain growth even if the U.S. market remains soft. Current valuation metrics, including a PE ratio below 20, make the stock attractive relative to peers. Conservative estimates suggest a fair value around $186, indicating room for upside. Despite short-term challenges and market negativity, Lululemon remains a profitable company with strong fundamentals, growing international presence, and a robust e-commerce strategy. Long-term, it presents a compelling investment opportunity for those looking past the current volatility. That's all for today. See you in the next one.